Welcome to the weekly update, where I'll go over the action in the market for the week of September 5th through the 8th, and then we'll see how things are looking for the week of September 11th through the 15th. We had kind of a down week on the daily charts. When we finished everything on Friday, we were kind of at a state of equilibrium. Well, we're turning a little bit more negative on the weekly charts after we had been showing some improvement. Longer term, we're still hanging in there pretty good, but there are some things we need to be concerned about. Also, we are coming into a weak season. September is not typically a good month for stocks. And we have a lot of different pressures that are being applied to the market right now that I'll go through. First things, before I get started on the video, there is a PDF that I upload with every video that I post. So you can come back and look at the slides. You can look at the charts to see if that will help you. I do have a private Facebook group, and you're welcome to join that. It's not really taking off all that much. I'm pretty much the only one that posts there, but I post every time I upload a video. And if you have any questions or anything you want to interject, we can do that. I might be changing the format in the future, but for right now, I'm still going with a Facebook group. I will go through the results of the latest poll, and then after I get done uploading this video, I will create a new poll for the upcoming week. And then I keep a real close eye on YouTube comments. I don't get an awful lot of comments, but the comments that I do get, I want them to be legitimate and sincere. And if you have a question, I like to respond to that. If they're garbage or crap comments, I usually just delete them. If it's just a statement that I can't really respond to, I usually don't do anything at that point. And then I also post the videos on YouTube and Rumble. So if you can't find me on YouTube for whatever reason, maybe my channel is down or bad connection, what have you, sometimes you can go over and look on Rumble, and here is the link to that channel. Also, please note that in the upcoming week, from September 11th through the 13th, at noon p.m. Eastern Time until 1 p.m. Eastern Time, I'm doing a free online course. You're welcome to come. We're going to use Zoom to do this. I did that with the 3-hour class a week ago, and that seemed to work out pretty good. I will record this as well if you're not able to attend. Now, what I'll be covering is my approach to technical analysis. I don't show a lot of charts in that section. I mainly talk about what led me to why do I look at things the way I do right now. I'll also be going through some strategies. Now, that went a little bit long in the 3-hour class. I'll try to shorten it up, or if I need to, I'll go into the 3rd hour where I'll be talking about support and resistance. I was a little bit shorter in that session, so it worked out to about 3 hours total. All right, let's go back and talk about this past week. For the week, we were down 1.29% with the S&P on below average volume. It's starting to pick up a bit, but we're still looking below average when we take the whole week together. The technicals, we're still looking at some positive things. We're seeing some things turning a little bit more negative now with the difficult week that we had. Longer term, we're still hanging in there fairly good. It's right about the fixation of the market right now is about inflation, interest rates, and growth concerns, and what's going to happen economically. You can make a big case that we're going to go into a recession. You can also make a case that we won't. Well, that's the debate that's going back and forth. And instead of just having these opinions flying around, we look at charts and keep our eye on things to say, what's the market tell us? What can we look at that's more objective, that's factual based? And we try to reach our conclusions there. It's still kind of cloudy, so we just kind of have to go through this day by day, week by week. And then we're kind of dealing with the end of earnings season and then any Fed speak that may come out during the week. Our trend is weakening. We're dropping below the moving average with the ADX, and the green line is positive. It's on top, but now it's declining after we had been seeing some improvement. So for the week, the Dow was down 0.7%. It held up about the best. The NASDAQ was down 1.9%, the S&P down 1.3%, and small caps, which have been having some trouble, are down. They were down 3.6%. So for the week, the stock market had a broad-based loss when you look at all of the different stocks. It was shortened by 1 day because we had Labor Day on Monday, and volume continued to be below average. Apple really was in the news a lot this past week, and I'll go through that. as well as interest rates, and then oil is really starting to rise. And those things together really put some pressure on stocks. Apple was down 6% this past week when China came out and said, we're not going to let our officials use Apple devices. Okay. Now, that not only hurt Apple, but it started to hurt other companies as well, because Apple's a pretty big player in China. And if they're starting to limit who can use Apple devices, what are they going to do to other companies as well? And that could really bite into profits. And for a lot of tech companies, they really rely on China as a source of their earnings and revenue. Oil prices are starting to go up. Now, oil can go up as stocks are going up, and we've seen that before a lot, but it's starting to go up on some news that could be inflationary. It closed at 87.47 per barrel, and Saudi Arabia and Russia came out earlier in the week and said, you remember that cutback in oil production that we talked about? Well, we're going to continue to do that till the end of the year. And so that's meaning that there's less oil on the market, less of a supply. The demand is still there, so that tends to push up prices. Interest rates and the dollar also rose. Those are pressuring stocks. The dollar's really been doing quite well. It's back above the 105 level for the dollar index. And interest rates are going up also, and that's starting to really concern the market. Then the economic data that came out, well, a week ago, it looked like bad news was good news, where the economic data was weaker than expected. Well, taken together this past week, it was stronger than expected. And so that might mean that the Fed has to keep rates higher for longer. And if it really gets stronger, they might have to raise interest rates at some point before the end of the year. Here's the chart that I've been showing in the daily video. I just want to make you aware of this, those that only watch the weekly video. We take an average of the VIX. Now, when the VIX is high, it's time to buy. When the VIX is low, it's time to go. That's the overall cliche that we use with this. The blue line is the average, okay? And then the red line is what's been happening. It's a little bit outdated now, but we've been tracking along this fairly well over the past year or so. If we continue to do that, that could mean that stocks are going to go down, because when stocks go down, that's when the VIX goes up. And we're also keeping an eye on inflation. We will get the CPI coming out this week, so we're going to get another take on that. This chart compares 1966 through 1982, and the gold line is just tracking what have we been doing from 2013 up to 2023, the end of June. So it's a little bit outdated, but if we continue along this same trek, inflation tends to fall, but then after that, it could really get quite high. And so we don't use this to make any kind of decisions. It's just kind of an interesting guide that we can follow and see how things are going. Another thing that I ran across, and Chris Shavako from Shavako Capital pointed this out in his weekly video. This is put out by RenMac, and I was able to find this chart on Twitter. And it's, okay, how high do interest rates go before we really start seeing any trouble? And right now, when we look at the 10-year yield, if we get to 4.02% and above that, that's when it could really have some impact on stocks. If we stay below that level, yeah, it's not the greatest thing in the world, but it may not do as much damage. So that's one of the reasons why we keep an eye, especially on the 10-year yield, but we watch all the different yields. Looking at our poll results for the last week, now this is from a week ago, so this is a week-old question that I was asking here. The S&P 500 and the NASDAQ 100 are still sitting at longer-term resistance. That's the weekly chart that I'll show you later on. Going forward, do you think we'll break above that? Do you think we'll break below it? And we're currently below it right now. Or that we won't really move all that much? Some folks thought that we were going to break above that. 43%, 14% said that we were going to fall from here. And 43% said that stocks will chop and not move much. We did decline, but last week we were up. So we're still not very far away from those lines on either index. And I'll show you that chart later on. After being stronger than expected earlier in August, the economic reports have started to be weaker than expected. What do you think will be happening going forward? This will continue 60%. The reports will become stronger again, 40%. That's kind of what spooked the markets this week, where they were coming out stronger than expected. So we were kind of leaning that way right now. as it looks right now, and isn't that nice? As it kooks right now, I just cannot stop making typos on these different polls that I make. I always make a mistake somewhere. Maybe I thought they had spell check. Anyway, at the next FOMC meeting, FOMC meeting, do you think that the Fed will raise rates 29%, lower rates 7%, and keep rates the same 64%? The market's pretty much going full on right now with they're going to keep rates the same. And then after Labor Day, so almost a week ago, do you think stocks will move higher? 23%. Stocks will go lower, 46%. That's what ended up happening. And stocks will chop sideways. We did see a lot of sideways action, but it was sideways with some downward bias behind it. Okay, looking at some Isabel Net blog charts, and I'm not showing all of them. I'm just kind of cherry picking through some that I think are more applicable to what we're trying to do. I'm trying to keep the videos as short as possible. They're long enough as it is. So looking at the seasonal pattern for the S&P 500 going from 1990 to 2022, that's the black line that we see right here. And I didn't turn on the laser pointer, so I'm going to go ahead and do that. And that'll get picked up here. So this is what we've been doing on an average seasonal basis. And then the red line is what we've been doing in 2023. Sometimes we get far away from the average. Sometimes we go under it, sometimes above it. So this just gives us an idea. But typically, September and into the middle to latter part of October is when we often see some weakness in the market. And so a lot of people are kind of concerned about that. Then looking at the equity bond ratio, and I have some other charts, and I also go through the intermarket analysis where we take equity or stocks, compare them with bonds, and then do ratios that we study. Well, what we see here is the red dashed line is the stock to bond ratio, and it had been going up and is now starting to come back down. I tend to look at this on a longer term chart, like a monthly chart. And then the blue line is the ISM manufacturing PMI, where it's still negative. It's still below 50 in the reading in and of itself. That's showing contraction, but it is starting to turn up. So if the stock market is doing better, do you think the PMI will start to do better? Or is the inverse of that going to help or happen where the PMI is showing some weakness, and will that drag stocks down below it? It's like, okay, here we go. And they also advanced this a couple months ahead, which I'm not a big fan of that, but it can still be useful. Earnings still looking good when we go out into the future, whether it's Morgan Stanley or the consensus. We're seeing across the board increases in earnings per share estimates looking out into 2025. That's justifying stocks going higher. Looking at FactSet, finally, Mr. Butters came back from his vacation, and we had a couple of posts this week. This one is from Friday. When they're doing their calls after they announce their earnings reports, they look for certain words, and then they take out those words and say, what's really important to folks? Well, the latest one has been AI, artificial intelligence, when they're doing their second quarter earnings calls over the last 10 years. And we're seeing a real big increase in that. That's kind of where it's at right now. Now, the ETF that we look at that looks at AI, that hasn't been doing all that well. And it's really been underperforming tech. But that still doesn't mean that it's not kind of the craze right now for what people are getting excited about. And then here's another chart that's saying that the companies that are citing, and I have to move this a little bit here. There's a bar here that you can't see that's blocking me. That what does their price do after they talk about these things? Over here on the left, the S&P companies that cite AI in their second quarter earnings, which is what we're going through now, we did see declines after that. Or if you go back to the beginning of the year, the companies that talk about these things, well, they really shot up. And even the companies that didn't talk about it as much still are seeing a bit of an increase. And that was earlier in the year as we're going through this difficult time right now in the market. Okay. Then the other blog post from, what was that, Tuesday. Fewer S&P 500 companies are discussing recession on their earnings calls. So they're still talking about it quite a bit, but it's really dropping off. It had been a lot stronger before. And there's more of this conventional wisdom that's starting to develop now that we might hit a soft landing. Now, there's a lot of evidence for both sides right now. We don't really know how this will play out, but it doesn't seem to be the big concern. It's gone on forever. It seems like it's been, well, a year and a half at least that they've been talking about this. All right, let's get into our charts and analysis. First, we look at the intraday chart where we start with Tuesday, where we were pretty much flat. We saw some weakness really develop on Wednesday, and we really went lower, and I had to put the S3 and S4 level on here. But notice how these lines act as really good support or resistance. We also were lower on Thursday, but this was a little more positive. We opened lower, but then spent the rest of the day clawing our way back and actually closed at the intraday high. We tried to go up a little bit higher on Friday, hit R2 as a resistance level, fell back down, came down to the unchanged level, and then closed up just slightly. So yeah, it was a negative week. We're trying to look at some positive things inside the market, and there are some things that we can latch onto. So for the week, and I just measure the 4 trading days that we had this past week. All of the indexes that we look at were negative, with the NASDAQ and NASDAQ 100 being lower the most. Then we go back to the beginning of the year. All of the indexes continue to be up, where the NASDAQ 100 and the NASDAQ, followed by the S&P, are still doing the best. Going back to the all-time high, all of the indexes are still negative, and where the NASDAQ and NASDAQ 100 had been in last place for a long time, now we're seeing small caps taking up the last place position, and then the NASDAQ, where the NASDAQ 100, which has the big mega caps that have been doing quite well, that's down less. Looking at different sectors. Now, this goes on a weekly basis, so it's probably Friday to Friday, but it may be 4 days instead of 5, or maybe 5 days instead of 6 days that we may count here. Where energy had a really good week. It'll have a good week, then it'll have a terrible week. Well, this past week, it was the strongest sector, followed by utilities, which have been under tremendous pressure lately. But all of the other sectors ended up being down on the week, with materials and industrials being down the most. Looking at our relative rotation graph, we're seeing some changes here. There's nothing really strong right now. There's nothing over in this plus area. Well, the discretionary and communication and tech, which had been really strong, they're still doing okay, but they're showing some weakness here. And we still have staples. They're looking pretty negative, where all of the other sectors, we've been seeing this gradual bit of improvement as they're turning more blue and they're looking a little bit more positive. We're wondering if we're starting to see some kind of a shift in the market. It's kind of too early to tell right now. Growth is still doing quite well, and tech is still doing well, but we want to see as this plays itself out. Then going back and looking at the sectors for just the week, utilities ended up being up the most, and they've just been getting slaughtered. And a lot of that they saw later in the week. Where the one area that has been strong was tech. It was down on the week, and then industrials, where all of the other sectors were up when you just take the 4 trading days. Going back to the beginning of the year, the areas doing the best are communication, tech, and discretionary. All of the other sectors are underwater. Going back to the all-time high, energy, which again saw a really good week. It's starting to get back some of the gains that it's lost, followed by industrials, tech, and healthcare, staples, and then all of the other sectors are negative. Looking at sentiment, we're getting more into the neutral phase. We're at 51 right now, where we had come up to a really high reading, showing that there was not a lot of fear. Everybody was really positive on the market. Well, we fell down below that. We started to show some recovery, but now we're starting to drop back down. Looking at the active asset managers, they gave us an extreme positive reading. We used that as a contrary indicator. Since then, they got pretty negative pretty fast. We saw a little bit of a bounce up with the previous week that was up. Well, this latest week was down. Now, this is also a week old too, so they're still being more negative overall. This is another chart of that same thing, where we came in at 49.73. The VIX ticked up just a little bit on the line chart and the bar chart, but it's still at very low levels overall. Some folks are wondering, is this that zero DTE thing that people are doing? Is that really skewing the VIX? I don't have a real good answer to that. But I do use a lot of different things to look at sentiment inside the market. including this, the ulcer index, where it did tick up just a little bit this past week. We're seeing a little bit more fear coming in. The RIDEX bear bull ratio, where they had become pretty negative on things. Well, as the market was going up, they reacted to that. So this really dropped, even though we saw just a teeny tiny tick up in the latest reading. We also had the American Association of Individual Investors, where they had become quite positive. Well, as the market's been having a little bit more trouble, they're reacting to that as well. They're still positive, but it is falling back a bit. We also follow the red line here, which is showing some gradual improvement in this sentiment. We compared the 1 to 3 month T-bills or cash with the tech sector. It's still hanging in there. When this line is going down, that's positive for the market. In 2022, we saw this black line going up. It still is continuing to decline. So that's longer term positive. Keeping an eye on some economic things. We have the latest reading from GDP Now, the Atlanta Fed estimate. Well, we're at about 5.5%, what they're coming in with. And when we look at the range of the top 10 and bottom 10 forecasts, we're at about 3.5% to the upside and a little bit over 1% to the downside. But it's positive. And here's what we're seeing it look like graphically, which this is pretty strong. Over 5%. That's pretty healthy growth. And then looking at the spread between risky and not as risky bonds, if we were running into some real problems, this ratio would be going up. It's still not really moving all that much. The Chicago National Financial Conditions Index, if we were having trouble, we would be going above this black line. We're continuing to decline. This hasn't been updated in a while, since the end of July, where it's just showing that banks are really tightening their standards. And then we did get an update of the real-time SOM rule recession indicator. We get nervous when we go above the red line. We're just coming a little bit above the black line. The smooth U.S. recession probabilities, again, we would get nervous above the red line. We're still at the black line, and this was updated recently. And the Brave Butters has not been updated since the end of July. This is also flattening out just a little bit. I was kind of hoping we would get an update of this, but it just wasn't available. Inflation. We will get CPI coming out this week, but we're going up just a little bit. When we look at the CPI and then the core CPI, they're jockeying things around as interest rates and oil have been going up, and it's trying to level off, but we'll get more of a read on that this week. Keeping an eye on the Fed. Right now, as of Friday's close, there's a 92% chance that the Fed is going to leave rates unchanged. And then it really hasn't changed all that much. The dark areas where we're at now, then we have a day ago, a week ago, and a month ago. It's gone up just a little bit, but folks have pretty much stuck to this idea that they're not going to raise rates. The Fed balance sheet continues to decline as they said it would. And here's the year-over-year change showing how the Fed balance sheet is going down. Now, looking at some of our charts, looking at breadth, we're still looking positive based on price. We're above the moving average. We ticked up just a little bit also with volume. So this is still holding up fairly well. Looking at the new highs and new lows, we did see where new highs started to fall, but we didn't see a real expansion of new lows. Our 4-week average is continuing to go up. That's the red line. And we're still continuing to advance with the 10-day or 10-week moving average. The advanced decline ratio turned down just a little bit, but is still above 0. That's positive. Accumulation distribution. We're seeing some concerning things on the daily chart where we drop below the red line, but on the weekly chart, we continue to be above the red line. Keeping an eye on our trend. We're still in a trending environment. We're still positive with the green line on top, but we did see the green line come down and we're dropping below the moving average. So we're positive, but it's a weakening trend, and we're a little bit cautious because we want to see the green line going up, not down. Our Arun is still continuing to be positive. The oscillator is above 0, and it was pretty much flat. The green line on top, that measures the buyers, and they're dropping off. The red line are the sellers, and that's on bottom, and that's also dropping off. So overall, when you compare the two, we haven't seen any change. The mass index, which we had kind of a weak signal that was generated on the daily chart, where it came right up to the blue line and then turned and went back down. We want to see that really break above the blue line. Well, we just didn't see that. So we're just going to have to see how that plays out. Also, while the daily chart, well, We were going down in August. That's when the mass index was going up. And then when we started to go back up, the mass index kept going up too. This tries to measure when will there be a trend reversal. When we get that signal, we're looking for some kind of reversal. But because we've seen both positive and negative things right now, we're not real confident about the signal it's giving us. Some other charts. Here's the daily chart where we're having a real difficult time getting above and staying above the 50-period moving average on the daily chart. We also have a pivot level at this point. You can see where volume, there was a day or two where we were above average, but for the most part, we were below. However, more positive, longer term, going back to 2009, we're still above the midpoint on the trend channel. Then when we look at the pivot points on the monthly chart where we hit this spot in July, and that's when we started to see lots of trouble, and we have not been able to come back up to that level yet. The 50-period simple moving average, we're falling back a bit based on price, but the red line is still below price, meaning price is above, and the red line continues to advance. The long-term trend, even with the weakness, we're still in an uptrend. The McClellan oscillator, this is a little bit concerning. We're dropping below zero. That's turning things more negative. So when we look at the summation index, we're still just a little bit above zero based on price. We're still below zero based on volume. That's giving us kind of a mixed signal. Looking at the Swenlin trading oscillator, we're dropping below the 0 point based on price and volume. That's more negative. The BPI, and we're seeing pretty much this exact same chart on the weekly, or excuse me, on the daily chart that we look at. We are dropping as the market's been having some weakness, but we're still above 50. So it's negative because it's declining, but it's positive because it's still above 50. Then looking at the PMO, we're starting to roll over with this price momentum oscillator. We're seeing a drop off in price and volume where they both went below zero. Looking at the PMO studies, where we're seeing a decline of the PMOs that are rising, we're also seeing it turn down with the buy signals, and we're also declining with the PMOs that are above zero. So that's a little bit more negative. We look at the Bollinger Bands, where on the daily chart, we've come right back down to about the midpoint. That just shows kind of indecisiveness. We're still above the midpoint on this chart, and down below with the percent B, we're not getting an extreme reading. It went down, but it's still positive because we're above the midpoint. And here's all of our oscillators, and unfortunately, I can't zoom in on these things, even though I'm using Zoom to record this. We're turning down with the slope and the TSI. We're also rolling over with the MACD. The PMO is looking weaker. The PPO, the TRIX is starting to roll over, and the KST is rolling over as well. So longer term, on a momentum basis, we're turning more negative. We're turning negative on the daily charts, but our longer term oscillators they're rolling over, but they haven't crossed over negative yet. The Chaikin money flow is still above zero, even though it's declining. We're more negative on the daily chart. We thought we were seeing some improvement, but we've not been able to get back above zero. The Chaikin oscillator ticked up just a little bit, but is still below zero. That's negative. The force index is still positive, even though it declined. And the money flow, still above 50, that's positive, but it is declining, that's negative. The rate of change, since we had the down week, we dropped below zero. Going back 50 weeks, we're actually breaking out a little bit here. We could be getting to kind of an extreme positive reading as we were going up. Then the RSI, we're still above 50, that's positive, but we are declining, that's negative. The weekly special K chart, we're still below the red line, which is the moving average. The daily chart, even though it's rolling over a bit, is still positive. So that's been giving us a mixed signal for quite a while now. The Stochh RSI, it had been extreme negative, showed some improvement. Now it's starting to drop back down and looking more negative. The Williams percent R, it's dropping as well, but it's still above 50. Ultimate oscillator has dropped below 50 and continues to decline. That's negative. The vortex, we're seeing the green line coming down a little bit. That's positive, but the fact that it's coming down is negative. The Copic curve, we're below the red line, so that's not giving us a signal right now. And then longer term, we're still hanging in there right around this blue line, which is a 10-week moving average. So that's also suggesting that we're kind of at a tipping, not really a tipping point, but like a fork in the road. We could justify going higher from here. We could also justify going lower. But all of the other levels are still holding up well below current prices. Our different charts, we're still looking okay with the Heiken Ashi chart, where we've turned more negative on the daily chart. The Kegi is still positive. It's black and going up, where it's black and turning down on the daily chart. The Renko chart is still positive, where it's still looking okay on the daily chart. The 3-line break is starting to look a little more negative. The ease of movement with the down week, we're right down below the midpoint. We're still above 0 on the 14-week, but we are declining. We didn't see anything new with the point and figure chart this past week. No new X's or O's, no new signal was generated. Our different trading systems, we had switched back to positive with the Elder's Impulse system. Now we switch back to neutral. Then this is negative, and we switched over negative on the daily charts too, where we have the dots on top now. So now we're seeing confirmation, and that is more negative. The PPO studies were pretty much flat with the long term, declined a little bit in the intermediate term, declining, and we're just barely above 0 in the short term. Then some different charts that you might find interesting. This is a daily chart, and we're focusing more on this middle area, what I'm calling an intermediate term trend line, where we broke down below that, we came back up, and now that acted as resistance, and currently we are still below this level. Our 50-day cycle, where we had been coming down, we thought we might be seeing a bounce here, and we did see that, but now the market's just kind of chopping around, and this cycle will, a new cycle will begin on October 11th. Then we're looking at the Dow to transports ratio. In a positive environment, we want to see this ratio going down, meaning transports are outperforming. We've been seeing the Dow outperforming transports, which is generally more negative. We also been keeping an eye on the NASDAQ. This has dropped below its 61.8% retracement level. So this is a support level that so far has not held. The NASDAQ 100, it's still dealing with this red line here, which was the previous high. And we've been having all kinds of trouble. We're also dealing with the 50-day moving average and some other pivot levels that are all converging at this point. Some broad market looks. Here's seasonality, where we're focused more on September now. We're down 3.5% so far in September. Looking at a blank chart of the S&P, the mid caps and the small caps are really lagging behind here. The mid caps have been hanging in there a little bit better, and the S&P, which has been seeing some weakness, it looked like it was starting to recover, but it has been outperforming. However, when you look at the Dow on the weekly chart, we're still in an uptrend. The same thing with the NASDAQ 100. The mid caps. And even though the small caps have been having some trouble, it's still in an uptrend, but it's dropping below this 50-week moving average, which equates to a 200-day moving average. That's a little bit more negative. In a good, solid environment, we want to see the small caps participating, and they just haven't been doing that. The NYSE, which is a very broad measure, is still in an uptrend. All stocks still in an uptrend. The 30 biggest software companies were right in between these two moving averages here, but still in a longer-term uptrend. Now, this is also encouraging. The FANG index on the daily chart, it's still hanging out at its 50-day moving average. Well, here we have a 13-week moving average, and we're still just a little bit above that level. So for the big tech companies, they're still holding up fairly well. ARK, though, it was actually up on the week. After it had come down to this red line, which is the 50-week moving average, it saw a little bit of a bounce up, but it's running into some resistance at the 13-week moving average. The banks were starting to show some improvement, but did not have a good week. The RSI is below 50, and the MACD, it's still positive, but it's rolling over. Looking at the deposits, we're seeing a little bit of a tick out in the deposits now. People are taking their money out of banks and getting into money markets because they get a better return without necessarily assuming more risk. Then here's just a blanket look at Dow theory with the transports in the middle, the Dow on top, which is now starting to outperform. And then we saw a lot of weakness in the utilities, but then they came roaring back this past week. Some other measures, the CRB index, this is starting to look positive. We've already switched positive on the daily chart. Now we're seeing that confirmed by the weekly chart, and that could potentially be inflationary. Oil, which has really kind of been in the news now, it's breaking out, and we closed at 87.50. We were down a little bit on Friday, but we really saw this going up the past couple of weeks. Copper, Again, this is a barometer of the economy. We're turning negative on the daily chart, and we're also getting ready to cross over on the weekly chart and look more negative. The dollar has been roaring back, and that's also been pressuring stocks. It closed above the 105 level. Gold continues to be in an uptrend, but we're seeing some recent weakness, and we're seeing that same thing with silver. Longer term uptrend, but coming back down to this 50-week moving average. Keeping an eye on interest rates. The total bond ETF based on price, we're starting to turn more negative as interest rates are going up. The stock to bond ratio shows that stocks, even though they've been under pressure, when you compare them to the price of bonds, stocks are continuing to outperform. We're looking okay here with our 1 month minus 3 month yield. We're still getting a negative result in this measurement that we do, which is how it should be. And then looking at the daily chart of how rates have been just really going up in the past, week to 2 weeks or so, and that's really been pressuring things in the stock market. Here's a weekly chart. Even though we saw a decline in the UK, they still have the highest rates. We ticked up this past week in the US. German rates also ticked up, and then Japanese rates still remain rather low for right now. Some relative studies. First, we look at the intermarket analysis chart going back to the beginning of the year. Stocks are still doing the best, followed by oil. And then we see the dollar doing better. It's starting to outperform gold, where bond prices are negative, and they dropped over into negative territory at the beginning of August. Going back to the all-time high, oil is still in the lead, followed by the dollar, and then gold. Stocks and bonds continue to be negative. The NASDAQ 100 to S&P 500 ratio is still holding up fairly well here, meaning that the NASDAQ 100 stocks are outperforming. They both have a lot of the same stocks in them, but to see this outperform is more healthy for the growth scenario. The S&P 100 is still outperforming the rest of the S&P 500. Growth continues to outperform value. Gold is still underperforming the S&P, even though gold is in an uptrend and the S&P has been under pressure. It's really been underperforming lately. And gold is also underperforming the rise in the dollar. As the dollar is going up, gold has been under some pressure. Bonds continue to underperform stocks in a shorter term chart that we look at. And the low volatility stocks just really falling down here. We're wondering if maybe we're hitting some kind of a double low. We did bounce up. We bounced back up a little bit this past week. Are we going to see more of a bounce out of this? Discretionary continues to outperform staples, and energy, which is bouncing back. Longer term, it's still underperforming tech. Some secular, which means very long term, can mean decades, and cyclical trend studies. Here's our NYSE breadth thrust. We had a signal that was generated in October 2022. This still is on the books. We also had a ZWAG NYSE breadth thrust. Apparently, it's doing a little bit better now. It had gone down here to an extreme negative reading, but this is more or less indefinitely on the books as well. And then the Zohorchak method. It's either on or off. It's like a binary number. If it's 1, that's a buy. If it's 0, that's a sell. Well, it's been on a sell signal now for a lot of 2023. Did I say sell signal? It should be a buy signal. Then this is a long-term weekly chart of the S&P going all the way back to the 1987 crash. Then I drew a line up to the dot-com bust low. That was in 2002 into 2003. We were able to bounce up off of that. And then we really hit some trouble when we had the great financial crisis and we broke below this. It took us a long time to get back up here. We hit this resistance level in 2018. We hit it again right at the beginning of the COVID plunge in 2020 with all of let me try that again. With all of the liquidity that came into the market, that just really shot this up higher. We fell down below it in 2022, and now we're coming back up to this resistance level. And then here we have a shorter look at that same chart where I start in 2018 and go to the present day. We're still battling this line. We could have a good week and come right back up to it. What we're going to be watching for is to see if we really start to drop down below this. Then here's the NASDAQ 100. Pretty much seeing that same thing, still battling this long-term trend line. Then we take the ratio of the NASDAQ 100 to the Dow. We're getting a really high reading right now, even though we didn't come back to where we were before. When we had a high reading like this, that was right before the dot-com bust. Then we had it right at the end of 2021. Now we're coming back up to this level. If we really start to fall, is that going to shift things more negative? So far, we've been watching this for weeks now, and it's not really giving us any kind of a conviction at this point. Then we're also keeping an eye on the MACD longer term on the weekly chart. It's continuing to be more negative. So that's more on a momentum basis. We're not looking positive right now. Then we have the latest email from Tom Bowley. He's with earningbeats.com, and he also is affiliated with stockcharts.com. In the month of September, which ends up being the worst month of the year, real estate tends to not be hot, and certainly it's living up to that right now, where the industrials tend to be hot, even though they've been under some pressure lately. We've surpassed the first part of the month now that tends to be positive, and we're coming more into the negative part, and then we're going to mix that up a little bit with another time that ends up being more positive, and then later in the month we end up being more negative. If you're interested in industry groups, we have footwear and airlines tend to do better in the month of September. So our outlook for Monday, and this is based on the daily charts, so this only applies to Monday. We're still dealing with some earnings reports. On the daily charts, we're mixed right now. We kind of weigh it on a scale and it's coming up even, but we're not trending either in our short-term ADX or our intermediate-term ADX chart. We won't get any economic reports, and I forgot to update this here, so just disregard that. We're still paying attention to what's going on in the world, the geopolitical events, but barring one of these crazy things happening geopolitically, the market is still fixated on inflation, interest rates, and growth concerns, and looking out into the future that earnings are still going to hold up. And then we're still wondering, is there more to this whole banking story than, are we waiting for the third or fourth shoe to drop here? Here's the economic calendar for the upcoming week. We don't have any reports according to the chart that I look at for Monday and Tuesday. We'll get CPI on Wednesday, PPI on Thursday, and then we're going to get industrial production and consumer sentiment will be coming out on Friday. The Stock Traders Almanac statistics for Monday, September 11th, kind of an ominous day in American history. We're neutral to positive with the Dow and the NASDAQ, where we're actually more positive with the S&P. We will be on the 7th trading day of the month. We follow the blue dashed line here, which is a pre-election year, where we tend to see more positive action. But notice later on how we tend to see more weakness as the month plays out. Looking at the NASDAQ, we will also often see some strength going up into the middle part of September and then weakness in the latter part. And then looking at the S&P, the green line, where we tend to see a good start to September, then some weakness, and we're wondering, is that's what is happening right now? And then are we going to get a little more of a bounce up out of this? But then we see weakness going into the end of the month. Going back to 1950, when you look at just pre-election years, the S&P is up 33.3% of the time. That means that it's down 66.6% of the time. So our scenarios that we're going with for Monday, we're not going with the down one, we're not going with the up one, because we're in a sideways trend right now, both with our short and intermediate term ADX. And the green line and red lines for both are pretty much on top of each other. That's part of the tipping point or knife edge that we're looking at right now. The warning signs, and these don't change all that often, but they really only apply to Monday's session. The longer term trend signals, that's the S&P weekly chart and NASDAQ 100 weekly chart. We're still below those trend lines, and that could signal that we're at a top. September tends to be a pretty weak month, especially as we get to the latter part of the month. The equity put call ratio that we've been watching is starting to go back up. We want that to go down. That would be more positive. The longer term equity put call ratio is also turning up, and it has not resumed its downward movement. We're still in a risk on posture, meaning folks are favoring stocks over bonds, but it's been showing some weakness lately. The cumulative new highs, new lows for the NASDAQ are showing weakness, and that's been happening for a long time now. The 3-month yield is still above where it was back in 2007. We're waiting to see if that chart's going to roll over, and it hasn't done that yet. The parabolic SAR chart for the daily version that we look at has turned negative, and then we're dealing with earnings season. The positive signs, the seasonality and setups that I went through, the Zahorchak, the Brett thrust for the NYSE, those are still positive. The long-term daily special K chart is positive. The weekly chart continues to be negative. We're still above the downtrend channel upper line. That's another trend study that I was doing, but we're still far away from that, so I haven't been showing that chart. The S&P 500 oscillators are starting to roll over negative. The one oscillator that we follow for the NASDAQ 100, which was showing some really nice improvement, it's now starting to roll over as well. The S&P is outperforming utilities, and the staples to S&P 500 ratio is declining. Usually both of these together give good support to the S&P. Really hasn't been happening. The Russell, the small caps, and the mid caps have generated recent golden crosses on the daily charts. Small and mid cap growth has been going sideways, but it's still positive. The financial sector, which has just been getting hammered all over the place, it still is working off of a recent golden cross. The Copic curve on the daily charts has generated a buy signal. And then, so our conclusion, we're mixed right now. How's that for being really decided about things? And we're not trending. You think the market's a little confused right now? We can say that for the short term as well as the intermediate term. However, in the long term, we're still positive because we remain above the 200-day simple moving average. Thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. Also, if you want to take part in that class, Monday, Tuesday, and Wednesday, feel free to do that, as well as check out the recordings, whether you attend or don't attend. So I hope you have a very nice weekend, and I will talk to you in the next video.